Hey, good morning, everyone. Marty Mazzora here. It is Wednesday, the 13th of September, 2023, with your midweek stock market snapshot. This will be our morning message this morning as well. Going to keep it really quick this morning. Time demands, or my schedule this morning demands that I do. But I think this will be important to peek at. We'll look at the S&P daily chart. We'll look at the QQQ, the ETF that tracks the NASDAQ 100 index. I want to look at the dollar, kind of update shift from the other day. I want to look at 2 and 10-year yields and how they're reacting to this morning's CPI print. So in front of you is the S&P 500, and just to again update you on the daily chart. So we failed at this uptrend line off of the March low. Hit on it for 3 days. Came down, busted through the 50-day moving average and the 20-day moving average, and then have recaptured the 20, but are having a rough time recapturing the 50-day moving average. The momentum indicators are really threatening right here. So not a great look right here in the short term for the S&P. I mentioned in the last video that CPI could move markets. It really isn't. I'll show you how the knee-jerk reaction was in interest rates in a second here. But as I speak, the S&P is up 21 basis points and the NASDAQ is up 33 basis points. Looking at CPI this morning, if I'd have saw these, or if I'd have known what they were going to be, I would have thought the market would have reacted more negatively, although the day is young. Like I said in the last video, and I showed you oil, I said I think headline anyway could come in a little bit hot. And the headline actually came in at consensus at 0.6%. Month on month. It did on a year-over-year basis come in a little bit hot, but those would be base effects. We talked about that before. But the core, which is supposed to be the Fed's focus, which X's out volatile food and energy, the consensus was 0.2 on a month-on-month basis, and 0.3 was hotter than expected. And there was an initial reaction to it that's essentially gone, at least as I speak. And then the year-over-year was just right on the consensus, 4.3. So a little bit hotter CPI, but no harm in the equity markets anyway, at least for the moment. You would expect that to be felt the most in the tech stocks. You could speak to utilities and so forth, but tech is very interest rate sensitive these days. And at least the NASDAQ 100 was up a little bit. 40 bips right now. Speaking of the NASDAQ 100, you've got a little better technical look, and I mean a little when I say that, because from a momentum standpoint, there's just no way a marginal new high is going to be met with any momentum confirmation right here. So you can go back to June, right? And we're back at 3-month ago levels still. So we've got this pretty nice consolidation range right in here that we will not live in for too long, I don't think, in this market. So we'll see a breakout in one direction or the other. Our view of the technicals definitely lean bearish right here before whatever's left in this cycle plays itself out. So quick look at the dollar. Remember I said the other day when we scored our equity market conditions index, we downgraded the dollar view from bullish, which is bearish stocks, the way things are trading right now, to neutral. But I did say that we were overbought and we had a bearish rising wedge. Remember I pointed to these spots here and showed that they tend to coincide with a dip in the dollar. Sure enough, big down day on Monday for the dollar, which coincided in a pretty big up day for stocks, particularly the NASDAQ 100 stocks. And then yesterday, the dollar actually came back a bit, and stocks had a rough day, particularly the NASDAQ 100 stocks yesterday. And then today we popped on the early news, and right now the dollar is actually trading down just a bit from yesterday's close. In fact, let me show you that pop here. We'll just look at a 3-day chart here, but it'll capture this morning. So there's the pop on the CPI news, right? So higher inflation would denote higher interest rates, which would denote a higher interest rate differential between U.S. dollar and other currencies. But you can see it's starting to inch its way back up here a little bit as well. Okay, so let's take a look at the 2-year Treasury yield. Now, 2-year Treasury yield is important because it really reflects expectations for Fed funds. And you can see, again, right at the that CPI print, kaboom, yields spiked. And in the futures market, stocks came down a little bit. And then it just came quickly off the boil and still higher and starting to inch higher again here as I speak. And as I speak, as these things are developing, a minute ago, the NASDAQ 100 was up 40 bips. Now it's only up 17. So these correlations on a short-term basis are pretty strong right now. The 10-year, it popped and then proceeded to just fall right back down to where it closed yesterday, and it's still kind of struggling with that right now. When I look at TLT, which gives us a view into 20-plus year Treasuries, price is down a bit, which means yield is up a little bit on the longer end of things. Our view, folks, though, is that highly likely or better than 50-50 odds that we see a recession in the not-too-distant future. And as that develops, we're going to see yields come down, and we're going to see inflation come down. And as I suggested in a recent blog post, initially we'll probably get stocks to rally. I mean, stocks are rallying for the most part on bad economic news, because the view is that bad economic news is going to bring the Fed in to lower interest rates because inflation is going to come down, blah, blah, blah. And that's going to be really, really good for stocks. Folks, I'm here to tell you unequivocally that bad economic news, if it ultimately morphs into a bad economy and a recession, and there's lots of under-the-surface indicators, despite what you may be hearing in the mainstream media, particularly on the consumption end, and I think I'll hit on that pretty hard in the end of week or over the weekend economic update. But when we look at the state of consumers and how they're acting and what they're doing and what they're saying, and this is a consumption-driven economy, and it has been the consumer/services sector that has held everything up amid a several-month recession in manufacturing. It's not, you don't feel real rosy about prospects. Now, let me say it one more time. Stocks will probably celebrate weaker economic news as it develops. Ultimately, very, very bad for stocks because it's going to do a real number on corporate earnings. Even tech stocks, it should do well initially because they'll reflect the lower, perhaps, interest rate environment. But in a recession, when you look at their valuations, they're really out over their skis, to put it mildly. So this does not mean, folks, clients in particular, that we know that the market's going to fall apart, because we don't. After doing this for 39 years, believe me, I am the definition of humble when it comes to trying to make short-term predictions on the market. But I think we can do a really good job of assessing risk and compensating for that accordingly. In today's world, what it means is if we can capture some upside like we have done this year in our core portfolio while protecting through options hedges and good diversification against massive downside. We can't capture any upside without any downside, but if we can mitigate the decline in portfolios, we can be in a position to take full advantage of those declines. And I'll close on this, and this is what I've continued to say, that when we look thematically out at what we believe the macro environment globally is going to be, we think it's going to be an macro investment rich market for several years to come. But we don't want to express those themes or those views to the extent that we will in an environment where we think in the meantime there's some real downside risk to the economy and therefore downside risk to stocks across the board and the ones that we want to own more of. And so we just have to be patient either until that downside plays out or until the conditions that have us concerned change or abate or diminish to the point where we don't have those concerns to the extent that we do right now. Doesn't mean we're going to have a massive recession or a massive sell-off in stocks. It just means the risk of something like that is out there, and therefore we need to be very, very patient and compensate or allocate for those heightened risks. I know I've said that a million times over the last several months, but until these things change, and they will, mark my words, make no mistake, that day will come, either when stocks move to valuations into levels that make sense given macro circumstances, and they are not there now in our estimation, particularly areas that we've been lessening our exposure to. At the end of the day, folks, it's all about managing the risk-reward setup, not about trying to capture every move in the market. Thank you, as always, for watching and listening, and I'll be back very soon. Take care. Bye-bye.